little known policy shift that took effect in March 2017 that is going to affect 12 million people who will see a jump in their credit scores.
Hey, welcome everybody to the podcast. We have an interesting topic here today. And, as you know, I'm Eric Worrell and I'm with Steve White, the co-host of the RentPrep for Landlords podcast. And I'm going to kind of pump Steve up a little bit before we get into this topic here, because I really truly believe there may be nobody better to talk about this topic as far as credit scores. If landlords are kind of running credit reports on their tenants and their applicants to see if they are a good fit for their property, there's a huge change coming down the pipe.
I was shaken, honestly, when I heard in March 2017, the announcement came out from the three major credit bureaus, which is TransUnion, Equifax, and Experian, that they were going to have a policy shift, that they were no longer going to report civil judgments and tax liens on people's credit reports, which is very, very scary, especially if you're a landlord that has a judgment against somebody. In the past, that's been maybe the only leverage you've had as a landlord to say, if you don't pay this, I'm going to get a judgment against you. And anyone who has a judgment knows having a judgment means almost nothing. It's your ability to execute that judgment, your ability to collect on that judgment. And the biggest incentive that people have to get rid of a judgment or to pay it is to get it off their credit, because it will take your credit down. It'll tear it down. So by the credit bureaus making the decision to remove that from credit reports, does a couple of things. Number one, you lose that leverage to say this is going to affect your credit because it's not any longer. Number two, the immediate impact that you're going to have, and these are the estimates from the Consumer Protection Bureau that gave these out, that said by July 1st, 12 million Americans will see a jump in their credit score. 12 million Americans. So you're going to see this overinflating of people's credit, which is, again, a scary thing. You've got people who, 12 million people who don't have the credit that they should, and not in a good way. And so these are people who, have been identified and statistically proven that you are twice as likely to default on a loan if you had a judgment filed against you in the past. And we've talked about this before. When it comes to evictions, there's that fear of the unknown, right? After you've gone through it, you lose that fear. First time you get an eviction, you lose that fear coming out on the other side. You realize you made it, you did it, and you're way more likely to have that happen to you again because of that loss of fear. Same thing with the evictions or with the judgments.
Steve, just for I know a lot of landlords, they do run background checks. They want to know, does this person have good credit and all those type of things. A judgment, take me through that process. So when does this come up for a landlord typically? Say somebody is renting from you, they are not paying rent, they get behind on rent and they never pay and you evict them and they owe you $1,000. Mm-hmm. What exactly does that process do? And then in kind of layman's terms, what does that affect the credit in the past up to this point?
So in the most simplest terms, somebody owes you money. You take them to, whether it be small claims court, maybe housing court, depending on how you're in this situation. If you went through the eviction, chances are you're going through housing court for this. But a judge will literally look at the case, look at the documentation that you have. Maybe you're adding some damages to that bill, on top of the past due rent, and you've got some pictures to prove it. You've got proof that they have a lease agreement in place and they haven't paid the past 2 months or whatever it might be. The judge gives the final approval and says, yes, I agree, this person owes you this money, pounds the gavel and says, this is my judgment. That's literally what a judgment is. It's a judge making a decision that, yes, this person owes you money.
Okay. So then now from this point, how does that landlord collect from that person? What is the motivation and how does that work?
So I would say the passive motivation is that the person doesn't want that on their credit for the next 7 years because it's going to bring their credit down. It's going to tear it down. Having a public record, having a history of delinquency, all of these things are codes inside of your credit algorithm, what gives you a credit score that will significantly tear your credit down faster than almost anything. So in the past, it has had a huge major negative impact on credit, which gives people incentive to pay it and get it off of their credit so that they can start rebounding and start building positive credit back up. The more aggressive way to collect on a judgment would be to garnish wages, which any landlord that's tried to do that in the past will tell you it's a very difficult thing to do. Usually really solid renters and homeowners have solid jobs. The opposite could be assumed for people who get evicted and who move from place to place and have these housing problems. They don't have solid jobs. Garnishing a wage is a very, very difficult thing to do if you got somebody that has not been at the same job for a long time. Number one, it's difficult to find where they're even working. Sometimes it's difficult to track them down. Sometimes they have all kinds of, issues that make their money somewhat untouchable. Maybe they're paying support judgments for child support. Maybe they're paying a whole bunch of other things. So it's a very, very long game to getting your money back on a judgment if you're taking the approach of trying to garnish wages. The only other real alternative that you have to execute a judgment would be a tax refund garnishment. We've talked about that in the past on the show. Again, not always the easiest thing to do. You have to assume that they're going to get a tax refund. You have to be employed, for all intents and purposes to get a tax refund. So again, this may not just be a perfect fit for every landlord that's trying to collect money from somebody who lives the lifestyle that makes it very, very difficult to collect on.
So the issue going forward, starting in July, when this goes across the board, across all three bureaus, is that basically there's going to be less motivation for this former tenant to pay you back what you're owed, because they're not going to have that repercussion of having that hit on their credit from these judgments then. Yeah,
precisely. Once they figure it out and realize that it's not going to show up on their credit, what's the incentive? And for a lot of people, for a good majority of these 12 million, I'm imagining, that have judgments on their credit, there's a majority of them on there that probably don't care and have just accept the fact that they do have bad credit. And so judgments no longer really affect them and mean anything. Now it's going to be even more difficult. There's not going to be that sort of
leverage, essentially.
Yeah, leverage, and just sort of that underlying agreement that we all have in this society that as a landlord, I know that a finance company may not approve this person for a new car. And that gives me some peace of mind, as it should. I don't want to know that the guy who owes me $2,000 on past due rent is now going out and driving a brand new car. That's not okay. So there was sort of this unwritten covenant that landlords had, knowing that they belong in a society that sort of supports them and their actions. So if you take if you get a judgment against somebody, that other industries are going to be supportive and say, we're not going to extend this person credit because they don't deserve it. And that helps incentivize that person to get out of that situation. Now that's gone. And again, it's a scary thing looking at the big picture in the future of what this means, because, in the credit world that we live in, things are looked at a lot of times by averages and thresholds and where people are at. And so this, on the low end, they're expecting at least 11 million people to have a 20-point jump at least.
Yeah.
And so if you're on the cusp of bad credit and that 20 additional points now puts you into average.
Maybe there's a threshold that a landlord has, or just somebody who's issuing credit, has for this. And then suddenly you just went from that C+ to B-, so to speak,
Yeah. And again, you're not factoring in the likelihood that this person is going to continue to run into issues. Mm-hmm. And when you start to factor that in, you start to really see the potential problems down the road that are just around the corner, I think. Not just for landlords either. And I think this is something that's going to affect the entire economy. At first, it's going to give you a very, very false boost. Everything's going to look awesome. Everything's going to look, great, that, hey, the economy's in great shape. Things are moving. We've got, a huge jump in consumer purchasing because there's going to be 12 million people with an inflated credit. Mm-hmm. Don't think for a second that they're not going to go out there and get credit cards and open lines and everything else. And then what are you going to have? It's a matter of time before they start defaulting. And now you're starting to run into a real bad situation. So I don't know if I might be the first one to say it. I don't know. I don't even want to predict something like this. I feel awful, and I certainly don't wish for it. But this is the type of stuff that tears an economy down in the future. And we saw it again in 2008. We saw something sort of similar. In the case of 2008, it was the fault of the lending industry. Their answer to writing more deals is, let's bend the rules, make new rules. Let's make it work. We'll make it work for our situation. And and we'll write these loans up and we'll have huge interest. And if they don't pay, whatever.
Our landlord listeners, it seems like there's two big takeaways to me from this. There's the issue of when tenants start to figure this out, that maybe there's not that kind of motivation to pay your debtors because it's not going to affect your credit like it used to be. That kind of affects all landlords. And then also that subset of landlords who do run a background check through a company like RentPrep to see, what is the history of this tenant. You're saying that for those background checks that they are going to be just a slightly rosier because that tenant's just going to get a boost. That applicant's going to look a little bit better than they did maybe 6 months ago before this went into play.
It depends on what type of background checks you're running. And I promise I don't want to make this sound like an obvious plug for RentPrep, but for years and years, we did not offer full credit reports. And there was pretty good reason for it. I mean, a lot of landlords will make the argument that they've got good tenants with terrible credit. A lot of landlords will tell us that, I don't even run credit because I've got, long-term tenants. They're great. They pay their rent every single month and they've got bad credit. So we just started recently offering landlords the full credit option. It's kind of terrible timing, in my opinion, now, because now it seems that credit just, in my book, got taken down a notch in terms of how relevant it is to tenancy.
Yeah, I mean, the only analogy that's kind of popping in my head, and maybe this won't really work for people if they're not like a big NFL fan, but I watch a lot of NFL. I'm a big Buffalo Bills fan. And there's all these passing records that they have right now. But like old school quarterbacks, like Dan Marino especially, like they'll like talk about, they're like, well, those aren't even real because it was a different game then. Well, what they did is the NFL changed the way the defense could play against the offense. So they made it more advantageous for the offense. And then what you saw is there's passing records being broken every single year, which is great for the NFL right now, the product that comes out, because people are excited and this is an exciting game. But at the same time, it kind of dilutes it a little bit after a while because you realize like, well, they're just kind of like messing with the recipe a little bit and making this thing appear more than it is. And it kind of sounds like what you're talking about here is that they're messing with the recipe of what credit is, and it's making things seem rosier than it really is.
100%, no question. Hockey's my thing. I could draw an exact parallel in hockey. They're talking right now of ways to increase scoring. The most obvious, I think, that they've come up with and haven't implemented yet, but make the hockey nets bigger. Mm-hmm. That's a great example of a regulation change that's sweeping. We'll change it, and you'll have a post, regulation period thereafter of that you have to kind of consider and look at stats and look at numbers and say, oh, that's
baseball in the steroids era. Yeah. There's kind of an asterisk next to all those home runs during that period of time where it was just running rampant.
100% correct. Yes.
So maybe there's kind of a little asterisk with credit for a tenant applicant going forward now, where you got to kind of dilute it 5-10% maybe.
Yeah, and I think it's more important now than ever to not leave it up to a credit report to make your tenancy decisions. This is the nail in the coffin for me. Before it was, different strokes for different folks. Some landlords love it. Some landlords base everything off the credit. Some don't. I don't think it's necessarily an indicator of how successful that landlord is or their ability to pick good tenants. I never really put a ton of value on credit, but now it's definitely lost a little bit more of its value, honestly. All of our RentPrep reports that we've done since day one include judgment and lien searches, and we never use the credit bureaus to find those judgments and liens.
So you can still get that information after this. It's just you can't get it through those bureaus and those typical credit reports.
Correct. You can no longer look at a credit report and see those records. Now you have to go to the courts, which is what we do, and look at records on file for civil judgments and tax liens. So it's still there. It's just not in a place where it once used to be. And make no mistake, it's not. I get why these changes were made. And let me just speak a little bit to that to help people understand why this happened. So, because it's a problem that we see in our industry every single day. The problem is, Eric, let's say you and I both have judgments, okay? And we live one county apart in the same state. And we both have judgments for the exact same amount, $1,500 to Chase Bank, let's say, okay? Both of us defaulted on our judgments on our Chase Bank credit cards on the exact same day. Chase Bank went through the collection process, couldn't collect from either one of us. And then they sued us in court and obtained a judgment that says that we owe this money. Before this regulation was passed, you literally ran into situations where the county that my record was reported in or recorded in would share the information with the credit bureaus, and the county that you got your judgment in didn't share their information with credit bureaus.
Okay.
So now you have a system that's essentially unfair.
Yeah.
Why is it fair that I'm being affected and you're not? And the problem really solely lies on the court system. Honestly, it's a standardization or a lack of standardization that's causing all of this.
So one county on average might have better credit scores than another county, and it all has to do with the fact that those courts just aren't reporting some of the negative factors that can affect your credit.
100%. Yes. And we see this constantly because a lot of data sources, a lot of data providers that obtain information from counties see huge gaps in information. Some counties, like Los Angeles County is a great example, are backlogged over a year. So you can have gotten a judgment in Los Angeles County a year ago today, and it still has not been filed to ever be searchable in public records, including your credit report. So because there's no standardization, because each county does not do things the same and is not required to do so, one county might say, we're going to share all of our data once a day to ensure that everything is as up to date as possible. And then you might have another county like LA County that says, sorry, we're pretty backed up. We'll get to it when we get to it. And again, it's creating this huge problem of not being fair to consumers. So I get their side of it. Unfortunately, the change that we all hoped for in this industry was that there would be sweeping changes to court regulations and standardization, and someone that came in there and said, hey, this is crazy that we've got 3,600 counties in the United States, and literally not two of them are the same, and nobody's doing the same thing, and everybody's running their own show. Let's at least standardize the process of how we're sharing our information and what you're doing so that we know the information that's coming out on the back end is good.
Yeah.
And that hasn't been done. And it looks to me like because of this policy shift, it's not going to get done.
Yeah, it kind of sounds like you got paint peeling on the wall because you got water dripping down the wall, and instead of fixing the water leak, they repainted the wall.
Yeah, that's exactly what it is. I mean, this is a Band-Aid fix, and I think it's, again, I want to be wrong on this, but this is one of those things that I think will have a long-term negative economic impact for sure. There's no question about it. So landlords need to be aware of it. For a few reasons, to know that credit scores as we know them are going to change. Our perceptions of them need to change. The national averages are going to now change. Right now, the national average for a tenant's credit score is 650, which is about 50 points behind the average for a homeowner. Mm-hmm. Renters, who are more likely to have judgments than homeowners, are now going to have the benefit of these inflated scores. And so now that's going to push them into homeowner range. So again, I think the overall lesson to be learned, hopefully, I think to help protect us from potentially failing economy over this, would be to change our perceptions on how we see credit. We have to change, we have to be willing and flexible to change those perceptions and adjust to them and say, okay, this isn't going to totally tear me down. I get it. I get what the changes are. I get that these things may not show up on the credit report anymore, are likely not to show up on the credit report anymore. So I'm going to dig a little deeper, turn over a few more rocks and see what I can find.
All right. Well, thanks for all the advice and tips here, Steve. I know I learned a lot, and hopefully our listeners did too. And just be aware of that and the changes that are happening, and those go into effect officially across the board come July 2017. So just keep that in mind when you're screening your tenants.